All right, I'm here with Ken Updegrave, who is a specialist in reverse mortgages. But today we're going to be talking about the Secure Act, the Tax Cuts and Jobs Act, and some of the future proposed tax changes from the Biden administration. Welcome, Ken.
Hey, good morning, Justin. Good to be with you this morning.
Good to have you here. To dive in, the Secure Act is one of those acts that it passed at the end of 2019, which was a couple months right before the pandemic hit. And it got a little bit of coverage in the news, and then the pandemic kind of took over the news cycle. Some of the key things that were in it, Ken, do you have a couple key points from the Secure Act that we can kind of lay out for listeners and viewers?
Well, I think there are a couple of things in the Secure Act that people need to really be aware of, and those are probably some of the things that gave us the most information as far as the media coverage on it to start off with. I mean, I think that the big thing in it is the elimination of the stretch IRA provisions in there. And the Secure Act, every government bill that gets passed has an acronym. And when you hear the word Secure Act and it says that it's securing retirement for our folks that are heading into retirement, you look at it, and when you really delve down into the numbers, it really does a number on people in a lot of the planning that they might have done in the past, as far as the elimination of the stretch IRA and what it does to their beneficiaries in the future, if that's part of their planning.
Yeah, so the stretch IRA is a technique that people used to use if somebody passes away. You've always, and you still can, your spouse can move your IRA or 401k into their IRA, and they can treat it as if it was theirs all along. But for non-spousal beneficiaries, if you pass away and money goes to your kids, that IRA used to be stretched out over the kid's lifetime. So a 40 or 50-year-old son or daughter that inherited a $1 million IRA could stretch it out and take $30,000, $40,000 a year, and it was treated as income, but it was in small amounts. Now, with the elimination of the stretch IRA, you have to take it out of this retirement structure in 10 years. Therefore, this 40-year-old that inherits a $1 million IRA from their parents looks at it and says, wait a minute. They may not even pay attention. They say, no, what, I got 10 years to figure it out, which is the worst answer, because now they're going to wait till the 9th year and then say, oh, it's not $1 million, it might be $1.5 million. And now I have to take it all out in 1 or 2 years. And now their tax bracket goes sky high because they just made $1 million in 1 year, according to the IRS. So hopefully they take it out over those 10 years, which stretches it out, but it's still, they'll be taking out 100 or more thousand per year, as opposed to the 30 or 40,000 a year. And that's material. It's going to bump them into a higher tax bracket, most likely. So this elimination means that retirees, near retirees that have those large 401ks and IRAs really need to be looking at it and saying, how do I minimize this tax burden for me and ultimately for my kids? Because I'm certainly more worried about me and my taxes, but there's no reason that the IRS and the government needs more of the tax dollars once I pass away. So just being a little proactive is kind of what we're talking about here, right, Ken?
Yeah, I saw a chart in one of the things I was reading recently about a gentleman that passed away with $1 million IRA, left it to his son who was 46. And fortunately for his son, and as far as from a financial standpoint, he passed away on December the 30th of 2019. And the projections were, this is what it looks like if he takes out required minimum distributions over his lifespan under the old plan versus the new plan, and having to take it out over a 10-year period on it. And basically the gist of it was by the time he was 82, there wouldn't be any funds. His because of the tax impact on it, that $1 million IRA would be worth zero at that point in time. If he had been able to take it out as a stretch IRA, it would have grown to about $2.25 million, and he'd have still have had the ability to take out his required minimum distributions over almost a 40-year time span. So it's a huge planning opportunity for folks that have, 6-7 figure IRAs out there that are maybe not immediately needing access to those funds, and they want to leave that as part of their inheritance or bequest to their next of kin, and just there's a lot of things that can be done right now. And my background in here is of Omaha, because I'm wishing I was out there for the College World Series. But I think in thinking about it, you can make an analogy with a baseball game. You can do a lot of small things. Hit a single, bunt and run over. Do that in a financial sense with your IRAs today, and it can add up to a whole lot of runs for you and your family in the long run. I mean, the things that I've read that make a whole lot of sense to me is looking at doing Roth conversions. And one of the reasons that makes sense, and one of the reasons Justin mentioned the Tax Cut and Jobs Act of 2017, was the tax rates went down. And if nothing happens going forward, they're going to go back up in 2025. So you've got a small window of 4 or 5 years right now where you could potentially make some big adjustments as far as changing some of your account structure around that can provide a whole lot of benefit to you and your heirs. $1 in a Roth IRA is not the same value to you or your heirs as $1 in a traditional IRA or a 401k. Right now, for most people, that $1 in a Roth IRA is probably worth somewhere right around 30% more than $1 in a traditional IRA, because the taxes have already been paid on it. And if tax rates go up, that number is just going to increase over time. So, I think when you're looking at it from a beneficiary standpoint, if you have the capacity to pay those taxes now, number one, if you pay them, you've reduced your estate because you paid those taxes. So if changes go into effect that reduce the estate tax exemption, you've decreased that number by having it in a Roth IRA and going ahead and paying the taxes. But you've also probably gotten in at a lower tax rate than you're going to potentially have in the future. And I think it makes a whole lot of sense to be looking at things like that, things like protecting a traditional IRA with a life insurance policy if you qualify for that, and that might be an alternative method on doing it. But no matter what you're doing and what you're thinking about with your planner, you need to be having these conversations right now, because there's a limited time window in there. And if you don't hit those singles and bunt those guys over, you're not going to get the runs that you have available to you. And I think that's an important thing to be thinking about now, as well as, if you've got charitable inclinations as far as part of your legacy planning, there's some opportunities there as well. And those types of things are things that you need to be talking about with your advisor as well.
Yeah, so you're exactly right, Ken. The Tax Cuts and Jobs Act, people call it the Trump tax cuts that we had in 2017. Tax rates, the 15% bracket went to 12, 25 went to 22, 28 went down to 24. And this means most people on average are in a lower tax bracket today than they were 4 years ago. And like you said, 2025 will be the last year of those rates, and then they'll bump up in 2026 to the previous rates again. So we're in this short-term window. Now Congress could extend it. I don't think a Democratic-led Congress is going to extend it. If Biden and Democrats get elected, that they're more likely to allow it to go back up. Republicans may allow it to go back up as well, but you're more likely to get tax cuts or extended tax cuts from Republicans. And we'll see what happens in 2024 to see if they extend that out. But the odds are, given the current status quo, we're in this tax dip. We're in the lowest tax brackets we're probably going to be in for the foreseeable future, maybe ever, for people's lifetimes. And I think you touched on it, the standard deduction bumped up. It's over 12,000 per person right now, which means a married couple with 20,000 of income is tax free. And so you really have a great opportunity right now to be in a low tax bracket. Now that's nice, you can enjoy it, but what you're alluding to and getting to is it might be a time to say, let's go ahead and front run some of these IRA taxes that are going to get paid eventually. Let's start paying some of them now, whether that's Roth conversions, whether that's withdrawals from IRAs and 401ks, and pay the tax in the low tax bracket. I mean, when taxes are high, you want to delay it. When they're low, you want to go ahead and pay them so you don't owe them later. And we've got this window for the next 5 years where we can really do Roth conversions and strategically play this tax bracket and say, hey, I'm in the 12% bracket. Maybe I don't want to go to the 22%. I want to just stay in that 12 and kind of max it out. Or maybe I'm in the 22 and I'm even okay going in the 24 because when tax brackets are going up, my 22% is going to go back up to 25. So I'm happy to pay it at 22 and 24 and not pay it at 25 in the future. And then kind of tying that back into the stretch IRA, my kids might be if I'm the retiree that's in a 12% bracket, my kids might be in a 22. It's like, I should be paying it in 12% instead of having them pay 22 or 24% when they inherit it.
Or even more likely, if it's a large amount and they've got to take it over 10 years, it bumps them up into a tax bracket that's even higher than 24% if they've got decent incomes. And, and it provides some benefit to the retiree as well, because, if you can take that strategic tax hit right now, it may reduce the taxes that you pay on Social Security. It may reduce the taxes that or the Medicare surcharges that you're paying in the future if you can reduce your taxable income as well. So there's a whole lot of planning involved in it that can be beneficial to not just your heirs, but to you in the future. And, having those conversations right now are important because not only are those Tax Cut and Job Act provisions liable to expire in 2025 as they are written into law, but the things that are being talked about right now as far as capital gains taxes, the elimination of step up in basis on that. I mean, if you've got assets that are in regular investment and brokerage accounts and the step up in basis rules change, those are going to get hit. But if they're in a Roth IRA or even in a traditional IRA, you're getting that deferred growth that wouldn't be affected by the step up in basis on that. So
yeah,
I think a big thing for people in trying to do this planning is they try to have to figure out where they're going to come up with the funds to pay the taxes on it. And that can be somewhat problematic for them. They don't want to take it out of the funds that they've got invested to pay the taxes if they don't have to. And that kind of brings about where what I do can come into play. Having access to home equity as part of your solution becomes even more important. I mean, you're looking at how do I maximize what I'm doing as far as my planning, because people, when they're looking at their planning in the future, basically the three things that are important to them in their plan are having control over their assets, having the ability to enjoy the use of their assets and being able to pass that on as a legacy gift, either to family members or to a charitable organization that's important to them, and doing that. And then, the third thing is minimizing the tax hit that they're taking on an annual basis and a lifetime basis. And, the way the required minimum distributions are set up right now, you start taking them and you have to start taking them now at 72. And that number is relatively small. And going back to the standard deduction that Justin talked about earlier, you got 12,000 per person, so a little over 12,000 per person. I think it's just slightly over 25 total for a couple right now. You know, if one of that couple passes away, that goes down, and you know, if they're if that's in a later part of their retirement, say they're in their 80s, that number that's in their required minimum distribution, not only are they having to take the required minimum distribution for themselves, but any IRAs that they inherited from their spouse, they're going to have to take the required minimum distributions for that. So it very easily can push them into a much higher tax bracket as a single than it would as a married couple. So thinking about and planning on this is, you know, like I said, it's a very limited time opportunity. You know, going back to my baseball analogy, you got 3 outs, and you know, if you waste one of them, it might get you a run, but you can't waste all 3 of them. You gotta look at how can I maximize my opportunities to live a better retirement life for myself, and you know, I think everybody has legacy goals, whether it's leaving funds for their family members or making charitable contributions. And there's a lot of things you can do with charitable contributions right now. If you've got traditional IRAs, you know, there's ways to get money out of traditional IRAs and into charitable opportunities without having to pay taxes on it in a number of different ways. You can do it through trust. You can do it through qualified charitable distributions directly from an IRA, but all of that can be part of your planning process and having that discussion with your advisor going forward. But going back to what I was saying earlier, you know, having that ability to tap into a tax-free asset, which is the equity that you build up in your home, can give you an opportunity to be able to achieve some of the things that you have a limited time opportunity to do. And with what I do, I work with exclusively folks that are over 62. We can set it up where you're not required to make a monthly payment on it, and have the ability, you know, either to tap into a fair amount of it to do the taxes in 1 year, or even better for most people is to spread it out over several years and have the ability to draw out that equity in a systematic manner to pay the taxes.
Yeah, and the estate tax limit went way up. It's over 12 million per person as well. And that means most people don't have to worry about an estate tax right now. But let's fast forward a decade from now, or after the laws convert back. What's going to happen to the estate tax? Are they going to drop it back down to 1 million or 2 million? And it brings a lot of potential households into this window where they might get an estate tax bill. And when they look at your estate, they look at retirement account, IRAs and 401ks. Those dollars are just as heavily weighted as a Roth or investment, a brokerage account, or cash in the bank, which means they're looking at it and saying, well, you've got this IRA and a portion of that is Uncle Sam's, but we're going to count that as part of your estate because it's still in your name, even though you know you owe the tax bill, the income tax bill on it. And so going ahead and paying that, whether that's from home equity or some other sources to go ahead and pay the tax and get that behind you, can actually lower that estate value and therefore lower your estate taxes. So you can actually get a double tax savings, one, by doing it now while tax rates are low, but two, doing it before you pass away, when they're going to look at it and say, well, even that portion that is taxable income in an IRA is going to get an estate tax bill as well. It's not relevant right now because the state taxes are high, but that doesn't mean it's going to stay that way. It's most likely not going to stay that way. They're as high as they've ever been.
Yeah, and realistically, I don't think that it probably will stay that way, no matter what kind of administration you have in the future. The need for funding for the government, the way government spending is going, is not going to decrease, and they're going to have to figure out a way to achieve that. And the estate tax seems to be a relatively easy opportunity for them, because there aren't that many people that it applies to, and it's a easy source of funds for them. And you know, if they eliminate the step up in basis on that, you're going to get they're going to be collecting taxes on inflationary gains as well that you're not going to get any benefit from. You know, there can be some benefits to that because a lot of people tend to lock in those gains and they don't want to sell assets because they can pass them on to their heirs and get that step up in basis. So it'll probably unlock some asset selling in the retiree's lifetime and probably provide some opportunities there. But you know, if they reduce that estate tax, there's going to be a lot of people that get incorporated into that, you know, from small business owners to farmers. All assets will be counted in it. So if you own a lot of farmland and real estate like that, that'll be incorporated into the count too. So
yeah,
you know, I think like I can't reiterate it enough. You got to take this opportunity while you have it, whether you need my services or Justin's services, or whoever you're working with. You need to be taking this opportunity to have those conversations and say, listen, you know, what can we do with where we're at right now that makes sense for us to be able to do? Because, you know, I don't talk to anybody out there on a regular basis who thinks tax rates are going down in the future. Everybody thinks they're going up. And, you know, the traditional tax strategy is always to delay paying taxes as long as you can. But in the environment that we're in right now, I think that strategy has been turned on its head, and you ought to be looking at paying the taxes now while they're at a lower point and doing what you can to not have to pay taxes later on when they're probably going to be at a higher rate.
Yeah, and that concept that delaying the taxes is a good thing was formulated as a popular opinion. They were promoting 401k plans where you could defer income, reduce your taxes today on your income. But it was also this mindset that taxes in the 70s and 80s were sky high, and they've been coming down and down and down since then. And now it doesn't make as much sense. And your traditional concept was, during my working years, I'm making a bunch of income, and during retirement, I'm going to be sedentary and stagnant at home. Today's retirees are not sedentary and stagnant at home. They're very active seniors, and their lifestyle is very similar to what it was pre-retirement, and therefore their income is as much or more. And it really does come down to the tax bracket question. So the one thing I want to point out is these are not just concepts and theories that Ken and I are just saying. I'm doing Roth conversions. I did a Roth conversion last year. I expect to do another one this year. Even though I'm 40,
as well.
I'm doing this because I see the opportunity, and I'm not 62. I can't go get a reverse mortgage to get equity out of the house. I have a traditional mortgage, but the concept is still there. It's I'm willing and actively paying more in taxes this year and last year and probably next year as a method, as a strategy to look back and say, hey, I got all these pre-tax dollars into post-tax dollars, tax-free dollars in the Roth. And then they can grow for, in my case, hopefully for decades, tax-free growth. And then I can use it when I want it, when I need it. It's just being proactive, and ultimately it may save a few percent on taxes, but it also gives you that flexibility in a Roth to say, hey, I want to go buy something, and I don't have to pay Uncle Sam just because I want to go buy something. It's an RV or a second home or anything. It's I'm going to go spend the 50 grand on whatever and go do it, the car purchase, and I don't have to worry about taking out 70 or 80 grand from an IRA to do it. And that may bump me into a higher tax bracket, which would ultimately discourage me from doing it. So it gives you that flexibility of purchasing power when you have Roth and after-tax money, just to say, you know what, I'm going to go do it, and I don't have to worry that specific year about the tax implications from that purchase.
And one of the things to think about in it, and particularly from a reverse mortgage standpoint, that people don't really understand is if you're buying a house and using the reverse to free up some liquidity to do things like this, or to free up the cash flow to be able to do something like this, or have an existing mortgage, this acquisition debt mortgage on that, most people aren't really getting a tax break from that acquisition debt, or if they're getting it, it's severely reduced because the standard deduction is so high for a couple that they really aren't getting but just a marginal amount of that tax benefit on that. With the way the reverse mortgage works, you need to talk to your tax advisor on this, but interest on it is accrued on an annual basis. So the interest that's accrued on that initial amount on an annual basis and it is added to the loan when it becomes payable, which is usually at death or when they've left the home or when they've sold the home as well. If you were planning on living in the house for 15 years and selling it, when you sell that home, you're going to pay off that mortgage just like you would a traditional mortgage. You have an interest deduction that you can take in that year. So that could be an ideal time to do a Roth conversion when you got a big interest deduction to take. But the other thing it can do is if you're leaving traditional IRA funds to your heirs, if you leave the home and the mortgage that's associated with it to your heirs, my understanding from what I've read from tax folks is that you have an ability to write off the interest deduction when that mortgage is paid off and when the home is sold, and utilize that to offset the income from the IRA distributions that the heirs are receiving because they're the owner of both of those assets at that time. So there's some kind of interesting planning techniques with that as well that can be incorporated into it. And the other thing from a retirement standpoint, or even from a Roth conversion standpoint, if you're making an existing mortgage payment and it's $1,500 a month and you're in retirement, you're having to figure out how to come up with 18 grand a year. Well, that isn't just 18 grand. It's probably more like 24 grand when you take into account the tax hit on that. Well, if you do that with this and you've eliminated that payment, that frees up 18 grand of non-taxable cash that you could use to potentially do a Roth conversion. And 18 grand, when you figure in state and federal taxes on it, that probably means you can do, $55,000, $60,000 Roth conversion that year and use that to pay the taxes on it instead of paying down the mortgage that you're probably not getting. Most of that's going to interest and not principal for a lot of folks.
Yeah, absolutely. Well, we unpacked a lot of things and there's tons more information. Any other thoughts we really need to bring up, Ken, that you can think of?
No, I don't think so. I mean, I like I have tried to stress in this is a limited time opportunity for people to have this conversation with their advisor and explore it. But one of the things I would say in it is you need to be thinking about how you can use all your available assets in making this situation work the best for you that it possibly can. And whether that's home equity or other assets in there, don't take anything off the table. Look at what your options are, because I think you might find that sometimes the options that you think aren't the best options could end up being even better options than you thought they would be.
Yeah, absolutely. How do people get a hold of you, Ken, if they want to reach out?
Probably the easiest way is to give me a call. My mobile number is 919-412-8389, and they can give me a call on that. I generally have it with me and answer. If I don't answer, it probably means I'm on the phone. And if you leave me a message, I'll give you a call right back and we can have that conversation.
All right. Thank you, Ken. I'm Justin Struble with BSG Advisors. I'm not a broker. I'm a fixer.
Sorry, I didn't mean to interrupt you there, Justin. Justin's got one of the best taglines in the financial advisory world, in my opinion. I'm Ken Updegrave, and I'm a reverse mortgage and home equity specialist with Fairway Mortgage Company.
Thank you, Ken. Good talking to you.
Good talking to you too.